with his speech called the SBE Depreciation Regime. The SBE Depreciation Regime, Peter Barty.
Ladies and gentlemen, tonight I'll be basing my presentation on an extract of a seminar I attended a few months ago, given by the NTAA, the National Tax Accountants Association, and the topic is the SBE depreciation regime. First of all, who can give a guess as to what depreciation is?
Something uses advantage.
Yeah, exactly. So if you buy something and its value declines over its effective life, then that is depreciation. If you're running a small business and whose turnover is under $2 million, then you can use the so-called SBE depreciation regime, which is a very generous tax depreciation system for you to use to decline the value of your assets. Previously, under the old so-called SDS system, if you bought an asset for under $1,000, you could immediately write it off. If it was over $1,000, you could either put it into a so-called general pool and write off 15% in the year you first bought it, and then 30% in each subsequent year. Or if it was a so-called long life asset, then you could depreciate it over 25 years. On the 1st of July 2012, they have overhauled this system, and basically all your existing pools, the general pool and the long life pool, gets amalgamated and is basically written off at 30% every year going forward. There are two groups of assets under the SBE system. Basically all assets except motor vehicles and motor vehicles. So most assets, if you buy something under $6,500, you can write it off immediately. The $6,500 is basically the GST exclusive figure. So if you're a small business registered for GST, and you can claim the GST on it, so if you buy something for say $7,150, then 1/11 of that, $650, is the GST, which you can claim, and you're left with $6,500. If you're not registered for GST, then the threshold is simply $6,500. However, the important point to consider is that only the so-called business percentage is deductible. So if you have an asset which you use both for business and private use, you can only claim the business use percentage. And the main thing here is that even if the business use percentage is less than $6,500, if the actual purchase cost of the asset is $6,500 or more, you have to depreciate. You cannot write it off. You have to depreciate it 50% the first year, 30% in each subsequent year. Another main benefit is that if you have an existing asset and you make an improvement to it, then you can, as long as the improvement is valued at less than $6,500, you can write it off in the first year. But this is only for the first improvement. and if this improvement is under $6,500. You don't have to aggregate assets. For example, if you buy 4 computers at $2,000 each, then the total cost would be $8,000, which is over $6,500. But because they're 4 separate assets costing $2,000, which is $6,500, then you can write off the whole $8,000, assuming that they're all used for business. If the balance of your pool reaches $6,500 or less, then you can write off the entire balance. Motor vehicles. Now they're an entirely separate regime. You can write off $5,000 of the cost in the first year. And the thing to remember here is that the $5,000 comes off the cost base. It is not an additional tax break or investment allowance as was previously the case. So it would be a flagrant disregard of taxation law if you decided to claim $5,000 up front and then continue on depreciating the whole value of the car. It would be double dipping. Another benefit is that second-hand cars are also eligible for this treatment. Now, I'm going to draw a quick diagram just to illustrate how the $6,500 threshold and the $5,000 motor vehicle threshold applies. I'll just bring this closer so everyone can see. And so basically, we have a motor vehicle here. And which, if it costs less than $6,500, then the business usage can be written off in its entirety. So 100% write-off. If it costs $6,500 or more, then the question needs to be asked, how much is the business usage worth? So if the business usage is 5,000 or less, then you can write off the whole amount, no questions asked. If on the other hand, the business usage is 5,000 or more, actually this is less than 5,000. Then basically you can claim the full 5,000 plus the 15,000 of the balance of the car after you take off 5,000. So the depreciation claim here would be 5,000 plus basically $5,000 the business usage of the car, there's the 5,000 already claimed times 15%, which would be the depreciation claimable in the first year. So this is basically a broad overview of how the depreciation interacts with the of motor vehicles interacts with the general depreciation rules. And finally, the question arises, if you sell an asset, then how do you bring that to account? Well, the answer is you have to, the sale proceeds go against the balance of the sale proceeds go against the closing balance of your general depreciation pool. If as a consequence you get a negative closing pool balance, then you have to bring in the balance, a negative balance, into account as assessable income. So basically this was a short overview of how the depreciation system works for small businesses. So just to summarise, if you have an asset other than a motor vehicle, you can write it off under $6,500. If it's a motor vehicle, then you could, if the business usage is less than $5,000, you can write it off. If it's over $5,000, then you write it off over 15% in the first year and 30% in all subsequent years. And if once you sell an asset, the closing value gets reduced by your sale proceeds, and your assessable income is based on that. So those